Hey everyone, it's Sherman here, a CPA at Life Accounting, where we help you save on taxes and increase your wealth. In today's episode, I am going to help you do this by explaining when to switch from an LLC to an S corporation. And when I say LLC, I am referring to sole proprietors and partnerships as well, who may choose to form an LLC for legal protection, but do not have to for tax purposes. Because to be honest, there are no tax benefits of forming an LLC. They are taxed the exact same way as sole proprietors and partnerships. While on the other hand, switching to an S corporation can provide substantial tax benefits, like lowering your self-employment tax as an example. But even still, there are some instances where switching to an S corporation can actually hurt you, and I will explain why in this episode. So stick around until the end for all of the details, and be sure to like this video to help me out here with the algorithm, and subscribe if you don't want to miss future videos that can help you save and make more money. All right, so look, 80% of businesses formed are sole proprietors and partnerships according to the Tax Foundation. And only 13% of all businesses are actually S corporations. To me, this means that 80% of businesses are potentially paying more in taxes than they actually have to, but only if they are earning above a specific threshold. And I will explain that threshold to you in a moment, but first I need to make sure that you understand how LLCs are taxed in the first place. That way you will be able to determine if switching to an S corporation can save you money and then when to actually make that switch. All right, so let's say that you just started a business. Well, the moment you earn $1, that money is considered taxable income. In the eyes of the tax law, all money that you received is considered taxable. And of course, the money you spend to earn that money is generally deductible. So you're effectively being taxed on the net amount, the money your business earned minus the deductions your business takes in that tax year. It does not matter if you are an LLC, a partnership, or an S corporation. All business income is treated in this manner. The key difference is in the type of taxes you are assessed on your net income and how those taxes apply to it. So let's say that you're an LLC, sole proprietor, or a partnership. In this case, there are 3 types of taxes that are applied to your income when you file your business tax return. Number 1, your federal income tax that is paid to the IRS. Number 2, your state income tax. This is paid to your state. And then number 3, the self-employment tax, and this is paid to the IRS for Social Security and Medicare programs. Both your federal income tax and state income tax will vary based on the tax bracket that your taxable income falls within. But then there's the self-employment tax, right? Because you are self-employed, you have to pay Medicare and Social Security taxes not once, but twice, which is what trips most people up. As an employee, you would typically pay about 7.65% of your paycheck in Social Security and Medicare taxes. And then the employer would have to match that and pay a 7.65% tax as well. But since you are self-employed, you have to pay both the employer and the employee portion of self-employment taxes, equating to a flat tax rate of 15.3%. In other words, you would pay over $15,000 in self-employment taxes on $100,000 in income. And that does not even account for the federal and state taxes you would pay. A single taxpayer earning $100,000 per year would be in the 24% federal income tax bracket. So that's another $24,000 in taxes that you would owe. And then if your state adds another 5% tax to that, then that's $5,000 more out of the door. Now all of a sudden you're left with just $56,000 out of $100,000 in business profits, not your revenue. It's almost like you did all of that work for your business and the government got paid just as much as you did, and that's just not a good feeling. But fortunately, you can do something about this. And that is where electing to become an S corporation comes into play. S corporations do not have to pay any self-employment taxes because technically you are not self-employed as a S-corporation. Your corporation would be a separate entity that then employs you. Therefore, you could potentially save thousands of dollars by simply electing to become an S-corporation. And I'll explain the math here in a second, but first of all, what is an S-corporation? The S-corporation designation is a special tax status granted by the IRS that allows corporations to avoid double taxation and pass their income through to their shareholders, just like LLCs, sole proprietors, and partnerships. But to be clear, an S-corporation is not a legal entity. You must have a legal entity in order to elect S-Corp status. For example, LLCs and C corporations can elect to be treated as an S-corporation for tax purposes. In order to become an S-corporation, all you have to do is file a Form 2253 with the IRS. And if you are accepted, you will file an 1120S when you file your tax return. All right, so back to the tax scenario like I mentioned earlier. S-corporations do not have to pay any self-employment taxes, but they do have to abide by one major rule. The owners of S-corporations must pay themselves a reasonable salary for the work they do in their business before receiving distributions of profits. The best way to think about this is to think of your business as a separate entity and yourself as an employee of that entity. In that case, you would receive a distribution for what you own, and you will receive a W-2 salary for the work that you perform. And the W-2 salary you take will be subject to payroll taxes, which do include Medicare and Social Security taxes. However, the idea here is that instead of being taxed on all of your business income, you are only being taxed on the portion that is directly attributed to you in the form of wages. The distributions you receive then will not be subject to any self-employment taxes whatsoever. So let me give you an example here. Let's say that your business earned $100,000 in net income. And let's say that you paid yourself about $35,000 in W-2 wages. In this case, only the $35,000 in wages would be subject to Medicare and Social Security taxes. So instead of paying a 15.3% tax on $100,000, you're just paying a 15.3% tax on $35,000, which equates to be just about $5,300. But wait, let's just stop here for a second. In the first example that I gave you, as an LLC, you would have paid $15,300 in self-employment taxes on $100,000 in income. But in this example, as an S-Corp, you would have only paid $5,300 in self-employment taxes on the same $100,000 in business income. In this scenario, as you can see, something as simple as the entity you select can save you thousands of dollars in taxes, and in this case, $10,000. Now, a common question we get asked here is, well, what is a reasonable compensation for S corporations? I explained this in depth in a separate video, so be sure to subscribe to our channel and check that out. But in general, a reasonable compensation to shareholders is normally at least 1/3 of the business profits. However, there are many things to consider here, so be sure to check out my video on this. And then the final question we need to answer here is, when does it make sense to switch from an LLC to an S corporation? Generally speaking, once your business earns over $50,000 in net income, switching to an S corp becomes more advantageous to you from a tax perspective. And let me be clear here, I am referring to net income, not revenue. If you earn $200,000 in revenue, but only profit $25,000, then filing to become an S corp is likely not worth your time. And here's why. When you are an S corporation, you will incur more fees. Your tax preparation fees will increase because now you're filing as an entire corporation, plus filing your personal tax return. And your accountant might even charge you to file the form to help you become an S corporation in the first place. Plus, there are also other fees to consider, like annual state fees and much more. So typically, it does not make sense to do all of these things if your business is not making a significant amount of business income. So if you are making less than $50,000 in net income from your business, then I would suggest keeping things lean and as simple as possible by operating as a sole proprietor, partnership, or LLC if you want that additional legal protection. And if you are making more than $50,000 in net income, then you can likely save some money by electing to become an S corporation. So hopefully this helps you out on your journey to save on taxes and increase your wealth. If you don't want to miss out on more ways to do this, then be sure to subscribe to our channel for more content like this. And if you enjoyed this video, please help me out here by clicking that like button below. Thank you for watching, and I look forward to seeing you again in the next episode.